When you apply for a loan, the approval process can take days or weeks, causing delays in accessing money needed for urgent expenses or opportunities. Banks create money by issuing loans, which simultaneously generate new deposits in customers' accounts, effectively increasing the money supply without printing physical cash. This money creation depends on banks holding enough capital to cover risks, so regulations limit how much they can lend relative to their financial strength. Banks must balance the incentive to lend more for profits against the constraint of regulatory capital and the risk of borrower default, which can reduce their ability to create money. Because banks create deposits through loans, the supply of money expands or contracts based on lending activity, which influences spending and economic growth. However, if regulations tighten or risks increase, banks lend less, slowing money creation and potentially reducing access to funds for businesses and individuals. Banks also hold reserves at central banks, but these reserves do not directly limit lending. Instead, capital adequacy rules serve as the main constraint on money creation. Unlike cash, the money created by banks exists mostly as digital deposits, which customers can use for payments, transfers, or withdrawals, bridging digital and physical money. This system means that money supply is dynamic, growing when banks extend credit and shrinking when loans are repaid or written off, affecting overall liquidity. Central banks influence money creation indirectly through interest rates and capital requirements, shaping banks' incentives to lend or hold back credit. The process also involves trade-offs. More lending can stimulate economic activity, but raises the risk of financial instability if too much credit accumulates. Individuals and businesses experience these effects as fluctuations in loan availability, interest costs, and the convenience of accessing funds for daily needs. Banks do not lend out existing deposits. Instead, loans create new deposits, which means the money supply grows when lending grows. Capital constraints require banks to maintain a buffer of their own funds, so excessive lending can deplete capital and restrict further money creation. Risk assessment influences how much banks lend to different borrowers, making credit availability uneven across sectors or individuals based on perceived repayment ability. Regulations aim to prevent banks from overextending credit by setting minimum capital levels and stress tests, which act as a brake on money creation. When borrowers repay loans, the corresponding deposits decrease, effectively destroying money and contracting the money supply. This cycle of loan creation and repayment creates a feedback loop that adjusts the money supply according to economic conditions and bank behavior. Because money is created through credit, the banking system links money supply directly to economic activity and credit demand. The reliance on capital and risk constraints means banks must carefully manage growth to avoid insolvency or regulatory penalties. Digital payment systems rely on this bank-created money, making the banking system central to daily financial transactions and economic functioning. Money creation by banks is thus a balance of incentives to lend, regulatory controls, and risk management shaping the availability of funds. Understanding this mechanism clarifies why money supply changes with lending trends rather than physical printing by central authorities. In summary, banks create money by issuing loans constrained by capital and risk, meaning money supply expands or contracts based on lending activity, not printed currency.